Today, we're going to dig into what was a really huge quarter for Wayfair, and we're looking at it all through the lens of their CFO. Now, this isn't just a story about selling more stuff. It's about a massive, and I mean massive, pivot towards profitability. So let's get into it.
And this quote from their CFO, Kate Gulliver, really just sets the entire tone. A 6.7% adjusted EBITDA margin. That's a key way to look at a company's operating profit, and hitting that number is a huge statement. It's basically them saying, hey, our focus on financial discipline, it is really starting to pay off. This isn't just a good quarter. For their bottom line, it's a historic one.
So here's our game plan. First, we'll hit the Q3 scorecard to see the big picture numbers. Then, we're going to uncover the secret sauce, the key metric that's really driving their profits. After that, we'll see how they're using that profit to make their finances rock solid. And finally, we'll peek into the future with their forecast for the super important holiday season.
All right, let's jump right into section 1, the scorecard. These are the headline numbers that tell the story of Wayfair's pretty incredible third quarter. First things first, revenue. Overall, they saw healthy 8% growth. But the really interesting part is the strength of their main U.S. business, which shot up 9% compared to last year. And with their international side also up 5%, it just shows that this isn't a fluke. The momentum is pretty widespread.
Now that growth is built on a really solid foundation, a gross margin of 30.1%. Just think of this as the pure profit they make on every single thing they sell, before all the overhead. Keeping that number above the 30% line, that is a fantastic sign of efficiency.
Okay, so you take that healthy revenue growth, you combine it with those strong margins, and what do you get? You get this. Adjusted EBITDA, that key profit metric we talked about, grew by a staggering 70+% year over year. The takeaway here is so simple. They aren't just selling more, they are turning those sales into actual real profit at an incredible clip.
So that begs the question, right? What in the world is the secret sauce behind this profit explosion? Well, if you listen to the CFO, it all comes down to them absolutely mastering one critical metric.
And that metric is called the contribution margin. Let's make this simple. You take the profit you made from a sale, right? Then you subtract all the costs that change with each sale. We're talking customer service, credit card fees, and of course, all that advertising. Whatever's left over, that's your contribution margin. It's the real cash you have to cover your fixed costs, like rent and salaries, and to pour back into the business.
So in Q3, Wayfair's contribution margin clocked in at an impressive 15.8%. That is a full 1.5 percentage points better than last year. And that's not just a tiny bump, okay? That is a fundamental upgrade in how profitable their entire business model is.
And this is exactly why that number is such a big deal. A higher contribution margin gives the company what the CFO called a wider envelope of dollars. It means they have so much more flexibility. They can put money back into making the customer experience even better, which helps them grow, while also becoming more efficient. It's like this incredible, powerful flywheel.
Okay, so Wayfair is clearly making more money. The next logical question is, what are they doing with it? And that brings us to how all this newfound profit is being used to build a much, much stronger financial foundation for the whole company.
Wow, this slide pretty much says it all. Just a year ago, Wayfair's debt was over 4 times its annual profit. That is a heavy weight to carry. Fast forward to today, and that number is down to just 2.8 times. That is a seriously dramatic improvement in a very short amount of time, making the company way more resilient.
So, how'd they pull that off? Well, the CFO laid it all out. They generated a cool $93 million in free cash flow. Then they took $200 million in cash and went out and bought back their own debt. And this was a really clever move, because not only did it slash their total debt and future interest payments, it also cut the potential for creating new shares by about 2.2 million. The CFO calls this their dual mandate: cut debt and protect shareholder value at the same time. Pretty smart. All right, so that's the story of Q3, an amazing quarter. But what happens next? Let's take a look at the forecast to see if they expect this momentum to carry them through the holidays and into next year. And here's the official guidance. They're expecting revenue to keep growing in the mid-single digits. That strong gross margin is holding steady, right there in the 30 to 31% range. But look at the bottom line. They're forecasting another very healthy profit margin of 5.5% to 6.5%. The key takeaway here is they don't think Q3 was a one-off. They see this level of profitability as their new normal.
And looking even further out, the CFO basically summed up their entire strategy in this one sentence. For 2026, the plan is simple, but it is powerful. Grow the business fast, but grow profits even faster. I mean, that is the literal definition of smart, disciplined growth.
Which brings us to our final big question. We've seen record margins, we've seen them master their costs, we've seen them strengthen their finances. So, is what we're watching here the start of a whole new era for Wayfair? One that's defined not just by growth, but by sustainable, powerful financial discipline? Well, based on everything the CFO laid out, it sure looks that way.